welcome to the webinar Trading Psychology and Discipline with Thomas. I'm Thomas. I will be attending today webinar. Happy to see you all. Feel free throughout the webinar to raise your hand if you have any questions. So first of all, if you don't know me, I'm an account manager, senior account manager in AvaTrade. I've been working here for the past few years, and during that time, I had the opportunity to work and speak with many customers and traders and see what are the main difficulties and issues they are having while trading. I'm going to share with you today some of the common mistakes and issues that traders are having while trading. And one of the most important thing is the psychology side of trading. And this is something that we will be sharing today. We will do a risk disclosure. Any capital market and trading information disclosed in this webinar is provided for informative purposes only and should not be constructed or applied as investment advice, recommendation, or suggestion. CFDs are a complex instrument that come with a high risk of losing money rapidly due to 57% of retail investor accounts lose money when trading CFDs with the provider. You should consider whether you understand how CFDs work and whether you can afford to take the high risk of losing capital. So today, the webinar agenda, I will be discussing trading psychology. Will provide an overview on psychology and how it will be the determining factor on your decision making when trading. Then we will be discussing mindset fundamentals, fear against greed, FOMO, fear of missing out, discipline, emotional triggers, how psychology will shape the outcome of our trading, common mistakes that traders do, like revenge trading, over trading, moving stop loss after setting it initially, closing winner positions, letting losing positions run, impulsive entries, emotional control tools, a 5-second pause rule, breathing resets, cool down periods, structured decision making, emotional detachment, routine and discipline, pre-market checklist, journaling, daily limits, consistency, habits, sticking to your plan. By the way, this webinar is going to be a build-up from the previous one. So the previous webinar we discussed mainly on simplicity, how to open trades, close position, how to get more familiar with the web trading app, calculation of profit, calculation of losses. So in case you missed our previous webinar, I highly suggest to go through the YouTube channel and revisit the previous webinar. But you can also attend today because every webinar will be a little bit different. So now we can continue. So in terms of the mindset fundamentals, what are the main fundamentals? What is this in general? So the fundamentals will be the core psychological principles that shape how us traders think, react, and make decisions in the financial market. So basically, it will determine how well each one of the traders will handle fear and pressure when something happens in the market, risk and uncertainty, different emotional triggers that cause us traders to trade in a more emotional manner. So a strong mindset in trading will help you to become more disciplined in your trading. First of all, to have a plan. That's very, very important. I believe many traders that I had the chance to speak with, they didn't really have a plan. And until today, they don't have a plan that is written down. And obviously, everything needs to be broken down to everything from A to Z. And after you do have that plan, you need to follow it and avoid the emotional side of trading. And I will share with you today also how you can set yourself with a trading journal and many different tools that can help you. So basically, a weak mindset leads to more impulsive trading, inconsistent results, and repeated mistakes that will be difficult later to keep a record of if you don't really have a proper way to track everything you're doing as a trader. So even if you use a good strategy as a trader, this can cause you to enhance odds of losing capital. So mindset fundamentals create foundation for emotional control, discipline and patience, a proper risk taking, consistency in following a plan, and clear decision making during a volatile market. In trading, psychology often influences results as much as, or even more, the analysis that you have. So even if you do have a certain strategy, and the strategy is amazing, it can still cause you a big harm if you do not know how to do the psychology side and become a more disciplined trader. So a strong mindset is the foundation of every successful trader. So I'm not sure if you guys are beginner or not, but every trader will sooner or later get familiar with that concept and how important it is. So in terms of fear against greed, fear and greed are the two strongest emotions that influence trading decisions. So it can be fear of losing money, or it can be fear of making less profits. If your position is already in profit, it may cause fear because you want to make more. And same thing, they often push traders away from their plan and into emotional, impulsive trading behavior that can cause you enhance odds of losing your capital. By the way, if you have questions while the webinar, you can always just write down your question and I will be happy to answer while we are discussing the subject or by the end of the webinar. So fear shows up as hesitating to enter good positions, closing winning trades too early, avoiding opportunities after a loss, exiting positions too quickly during a volatile market. And opposed to fear, greed shows up as increasing a position size after a win, holding trades for too long, ignoring stop loss rules. And as we discussed in our previous webinar, risk management, money management. So you set a certain portion out of your equity that you don't want to lose more than that portion, and risk appetite that you set. Chasing fast moving markets without a plan. So always you should have a plan to everything. And unfortunately, this webinar is not in Arabic. It's only in English. So I cannot really talk Arabic, unfortunately. A balanced mindset helps traders avoid emotional extremes and make clearer, more consistent decision. So eventually, we want to have a plan and to learn how to follow it. So in terms of FOMO, we have a fear of missing out, which is a very big psychology concept that also it's causing people for, as you can see, FOMO is one of the most common psychological traps in trading. So it can push traders to act emotionally instead of following a specific plan that you set. For example, if right now there is something big happening in the market and you are afraid to take advantage of a certain opportunity, so you may miss out, or on the contrary, you may decide to close the position too early due to something that is happening in the market, although it is against the strategy that you initially set. How FOMO appears, entering trades too late because the market is already moving, um, jumping in without confirmation or analysis, copying other traders or reaching instantly to news. Unfortunately, again, sorry, this webinar is not for Arabic speaker. If you cannot speak English, so you can leave that webinar. Maybe it's not relevant for you. Copying other traders or reacting instantly to news, feeling pressured not to miss a specific market movement. What causes a fear of missing out? Seeing big candles or strong momentum, watching others make profits, recent losses or frustration, a lack of patience or confidence in a specific strategy that you have. FOMO leads to impulsive entries, poor risk management, and inconsistent trading results. Traders reduce FOMO by testing their plan and accepting that missing a trade is perfectly fine. So again, we go back to having a plan and following a plan. The next fundamental will be discipline and patience, which is one of the most important things as well for traders. Discipline and patience are two of the most important skills in trading. They allow traders to follow their plan, control emotions, and avoid impulsive trading decisions. What discipline means: following your strategy consistently, respecting your stop loss and take profit levels, keeping position size under control. Again, you can set your own risk portion by adjusting the lot size. That's, you can visit the previous webinar, I discussed that one. Avoiding revenge trading after a loss. So if you have a certain loss, sometimes you keep trading and trying to overtrade until you recover that loss that you had. Not trading when market conditions are unclear. And what patient means: waiting for high quality setup, for example, a certain support or resistance, or obviously following a certain strategy that, for example, pending order. So if you set a pending order, once the price hit a certain value, you patiently wait for the position to execute. Again, I discussed pending orders in our previous webinar that you can also view on our YouTube channel. Not trading out of boredom or frustration. You trade because you have a reason to place an order. You have a certain strategy that you follow, allowing trades to develop without micro managing, accepting that not every position offers good opportunities, and not every day, of course. Some days have a lower chance of different market movement, depends on your strategy. Now I see we have a question here: how can I start in this field and become a professional trader? So essentially, in order to become more professional, you need to gain experience, you need to gain knowledge on how to trade. Today is a good start for you because we are discussing what fundamental things the trader needs to have, and we're learning more about psychology of trading. So I suggest you to keep learning more and more, and also you can trade and improve your trading as you go. Also, if you have an account with us above a certain threshold, you can also request a call from an account manager, believe above $1,000, you can get an account manager, and also you can schedule call with him and ask him what things you can do to improve or how can you learn more. And of course, you can visit the webinars. This is a few seminar that we are doing, a few different sessions, one by one. Every time we will be discussing something else, psychology of trading, then we go into trading, opening trades, closing trades, going through different kind of trades. So every webinar will do something new. In terms of mindset fundamentals, we have common emotional triggers, sudden profits or losses, large market movements or high volatility that can trigger you emotionally, news events and unexpected market spikes, a losing strike or a big win, a personal stress, tiredness or distraction. How emotional triggers affect traders, overreacting to short-term price movements, closing trades too early or too late, increasing position size emotionally, entering trades without analysis, breaking risk management rules. So I'm sure if we have some traders here in the crowd that have been trading for quite some time, I'm sure that you are feeling a bit familiar with some of the things that is written here. And obviously, this is an important part of trading, and it happens to a lot of traders that are trading regularly. If you are beginner, so it may happen to you. So that's why we are also having this webinar for you to try and avoid making the common mistakes the traders are doing. Another fundamental is risk perception. Why risk perception matters, traders often underestimate the danger of opening a bigger position. If we go back again to what we discussed before in our previous webinar, the way it works with the position size, if you trade on a bigger position size, the profit or loss per each point will be bigger. So you are the trader, you can decide to trade on a smaller level of risk or sometimes trade on a bigger level of risk, depends on your risk appetite. High leverage increases emotional pressure and stress. Again, the leverage only means that the required margin to place an order, it can be higher or smaller, depends on the leverage. You are the trader, so you can always reduce your level of risk, or accordingly, you can take full exposure of the account and take bigger level of risk. Smaller position size allow a clearer, more rational decisions. Poor risk perception shows up, overconfidence after a winning position, taking larger trades to speed up profits, ignoring your stop loss levels, believing a trade is safe based on emotion and not based on your analysis. Healthy risk perception means respecting position sizing rules, understanding that losses are part of the process, and managing leverage carefully, making decisions based on probability and not on emotion, and also based on a specific plan that you can perfect as you go. If you have a plan, and later we'll discuss about how to set a journal. A journal is something that you can keep a record of your positions. So here we have another fundamental: confidence against overconfidence. Confidence is a trader ability to trust their strategy and follow the rules. So even if you do have a strategy, and let's say the strategy is not good, at least you know what is the strategy, and following the strategy is something that can take you to the next level, because you only need to perfect it and improve it. Overconfidence appears when a trader become too certain, so-called arrogant about their trading, ignore the risk that involved with trading, and stop respecting the plan that the trader have set for the position or for the trading in general. What healthy confidence looks like: following your trading plan consistently. So you consistently follow the plan that you set in advance. Taking trades only when your setup appears. Respecting stop loss and position sizing rules. Accepting both wins and losses regularly and calmly. What overconfidence looks like: increasing lot size after some winning trades, taking trades outside your strategy, ignoring stop loss levels, believing the market won't go against you. Why this is relevant and matters: confidence leads to discipline, stability, and long-term consistency in your trading, and overconfidence leads to larger losses, emotional decisions, and more rule breaking. A balanced trader stays confident without letting success turn into reckless trading behavior. Again, I'm sure that some of you are familiar with the things I'm saying, and also the things happen to you. You can feel free to keep asking us questions. For now, I see only a few questions from the same person, and I answer the questions. Another subject will be common trading mistakes, revenge trading, entering new trades immediately after a loss to win it back. So if you had a loss, you're trying to open another position outside of your strategy to try and make profit. Over trading, taking too many trades, trading out of boredom or forcing setups, moving stop loss levels, adjusting stop loss further, closing winner positions too early, selling profitable trades too quickly due to fear of losing, letting losers run, holding losing positions and hoping they reverse instead of respecting the rules. The rules that are obviously decided by you. You set your rules in your strategy. Impulsive entries, entering trades without analysis, confirmation, or a clear plan. So basically, these mistakes are common among both beginners and experienced traders. The key is recognizing them early and building discipline to avoid these kind of mistakes. And again, I've been working AvaTrade for many years, and I can tell you that a very big amount of traders have a bigger issue in psychology of trading than the analysis of trading. So some people can be very good in analysis, but they cannot keep the plan that they are setting for themselves. And some other people, on the contrary, they are good with psychology, but they are not good in the analysis itself. So a good trader needs to do the combination between the psychology side of trading and the analysis itself, which means deciding what will happen to the value of the asset. If you think it will go down or if you think it will go up, and then opening positions accordingly. So another common mistakes we have here: emotional control tools help traders make logical decisions instead of reacting impulsively. Simple techniques reduce emotional trading and improve consistency. For example, 5-second pause rule. So you pause for 5 seconds before entering or adjusting a trade to break emotional impulses. So instead of just opening a trade, you wait 5 seconds, it can be even more. Even before you change a stop loss or take profit, you wait and you take the time to think about it. Breathing reset, slow, deep breath, calm the nervous system and reduce stress during volatility moments. Cool down periods, take short breaks after big wins or losses to avoid revenge trading or overconfidence. Structured decision making, use checklists or rules to answer key questions before entering a trade. By the way, if you want this presentation also, we can edit. You can write here on the questions. I can edit also the to the webinar itself. Emotional detachment, treat each trade as one of many, not something personal, to reduce emotional pressure. These tools help traders stay more calm, focused, disciplined, even in a fast-moving market. We have another trading mistake, which consists a routine and discipline. Strong routine and discipline habits help traders stay consistent and avoid emotional decisions. Good trading is built on structure, so you need to have a certain structure and a plan, and not base your positions on luck. Pre-market routine, review market condition, key level, and plan setups before trading begins. So you have a set of rules that, based on the rules that you set, you decide whether you want to place the order or not. Daily loss limit, you set a certain exposure, a maximum loss for the day to prevent emotional and reckless trading. You can set a loss limit on a daily basis and a monthly basis. Loss limit is something that you decide with yourself what is a certain amount of money that you want to limit your loss with. Consistency in habits, follow the same rules, time frame, and process every day to build stability. For example, you decide to analyze according to 15-minute candle, 1 hour, 4 hours. Also, you can maneuver between them and build yourself a certain system that is working for you the best. When you decide when to put your support, when to put your resistance, or when to place an order. Sticking to the plan again, execute only when your setup appears and avoid trades outside of the strategy that you set. Routine and discipline allow traders to stay focused, avoid impulsive behavior, and build long-term consistency in their trading. Case studies. So obviously, always you can find a lot of case studies on ChatGPT or Google or all over the internet and see what kind of trading journals people use and what strategies they are using, and always gain more and more information to increase your odds of becoming a successful trader. Case studies, real trading examples help traders understand how psychology influences results in practical situations. Psychology failures, the trader increases a lot size after a win, become overconfident and take a large loss. Another trader moves stop loss repeatedly, turning a small control loss into a big fiasco, an emotional one. Discipline mistakes, trader enters multiple trades or out of frustration after a losing strike, leading to overtrading and leading to even more losses. Another trader exit winning positions too early due to fear. So again, not sticking with the plan, missing long-term profits opportunities that he could have made. And this is something very big that happens a lot, that people decide because of the decision that is not rational. They decide to suddenly close a trade that is winning or close a trade that is losing, and they are not following the plan that they set, and it's causing them eventually to more losses. Success through discipline. A trader follows their plan, respect their stop loss, maintain consistent position sizing, leading to steady long-term results. And also, if you do follow a certain discipline plan, so then at least you know what is working for you and what is not working for you. But if you keep changing the plan due to emotional things that are happening, so in that case, it is very difficult to know whether your plan is working or not. Another trader journal, each trade identify emotional triggers and reduces impulsive decisions over time. We will go through trading journal today very quickly because it's a big subject, how to set a journal and to set a certain decision-making process before opening a trade and also analyzing your positions. Key lesson here, the strongest traders are not those who predict the market perfectly, but those who control their emotions and follow the rules that they are setting consistently. So trading journaling, this is one of my favorite subjects, and basically keeping a trading journal helps trades and traders improve self-awareness, discipline, and decision making. What does it mean? Trading journal is basically you set a record of the position that you are about to open before opening the trade and also after opening the trade. So you need to analyze the position that you've opened so you know what exactly you've done and why you decided to place the order. So what to record, entry and exit, price setup, and the reason for entering. The reason is important. Why you open the trade? Based on a certain fundamental event, based on a technical analysis. If you identify that the value of something you are trading on reach a certain support resistance based on technical indicators. So then we have risk, stop loss, position size. You record emotions that you feel before the trading, during the trading, and after the trading. Mistakes made or rules that you have set to yourself, and unfortunately you decided to break these rules. So you record it as well into your trading journal. What you learn from the position. You can learn a lot as you go while trading, and then later you can analyze what you've done wrong. So this is also very important to learn from each position that you're opening, whether it's a winning trade or whether it's a losing trade. There is always a lot to learn. Why does it matter? Why do you need this journal? To identify emotional patterns, to help avoid repeated mistakes, to build confidence in your strategy, improve consistency and discipline. Trading journal is one of the most powerful tools for long-term psychological improvement. And again, the most important thing for me in a journal is that you can set a strategy and you clearly know whether you follow the strategy that you set or whether you didn't follow the strategy. And if you didn't follow the strategy, this is a psychology problem, and it's not It's not analysis problem. And if this is the analysis problem, so sometimes it's easier to fix the strategy and improve it than improve what we are talking today, which is the psychology. So let's give an example for how a trading journal looks. You can always set it up in a way that that you want. It's based on your strategy. For example, we have daily trading journal entry, position that you open, whatever you traded on. For example, let's say Euro, USD long. So you think that the value will go up is a buy position. Date, when did you place the order, was on 12th of February 2025. Setup, breakout plus retest. This is something that you need to set a plan based on what you would like to place the order, and obviously you need to place it based on that plan. And then you write the entry, the stop loss that you set, the take profit, the position size, the reason for opening the trade, for example, the price broke resistance and retested with the strong bullish momentum. Another example could be based on a big financial event that is happening in the markets. Emotions before, hesitant during, nervous during a pullback, after, relief and confidence. Outcome, for example, plus 28 pips, take profit, a mistake, a move, the stop loss too early, almost got stopped out. Lesson learned, trust the original plan and avoid interfering with mid-trade. So basically, this is a certain conversation that you are making with yourself on how to keep a better trading record. Then you can do a weekly summary, the total positions you open, the win and loss ratio, the main mistakes you had, the main improvements you want to have for the following positions, the goal you have for next week. The goal, again, you set. It can be a goal of profit, it can be a goal of not opening more than 5, 10, 20 positions, or whatever goal that you set. A monthly summary, the win ratio, monthly returns, strengths and weaknesses that you had, psychological progress, a yearly summary, annual growth, best worst months you had, biggest lessons that you learned, and the focus that you want to have for the next year. So here we have weekly trading journal summary, the week of 10 to 14 of February, total positions 12, win lose ratio 7 wins and 5 losses. By the way, of course, win is a position that you made money, and loss is a position that was not successful. You lost money. The main mistakes you had, overtraded on Wednesday, moved stop loss twice emotionally. Again, you were not following the plan. Main improvements that you want to have, followed plan more consistently, better patience, waiting for setups, a goal for next week, maximum trade per week, per day you choose, up to 1, up to 5, up to 10. You don't even need to trade daily, up to you. No moving stop loss unless part of the plan. Then we have a monthly trading journal summary, month, February 2025, win ratio 58%, monthly return 4.3%, strength strong performance during trending markets, improved discipline with risk management. Weaknesses you had struggling during high volatility news, emotional exits during losing strikes, psychological progress, less FOMO, more confidence in waiting for confirmations. Then we have a yearly trading journal summary. For example, here 2025 annual growth 22%, best months that you had in terms of profit, of course, or you decide. March, October, worst month you had July, overtrading plus low discipline. Biggest lesson, stick to daily limits, avoid trading when tired or emotional, high probability setups, frequency, focus for next year, increase your consistency, reduce emotional mistakes, improve patience during slow markets. So here is the Q&A, connecting psychology to real trading. I will be answering your questions, address common challenges, fear, hesitation, overtrading, impulsive decisions. So you can feel free to write down more questions, clarify psychological concepts with real examples, applying psychology in real trading, show how to use routines, discipline, risk management, emotional control, explain how to use tools to improve decision making in live markets, improving daily habits, encourage setting up a trading journal, reviewing mistakes and trading, tracking emotions, help traders stick to their trading plan and strategy, practical follow-up steps, invite traders to our future webinars, share educational resources, recommend tools that support better trading discipline. Q&A help traders bridge the gap between theory and practice, leading to real progress and long-term consistency. So from all of the above here, what we can learn, okay, for example, first of all, in our previous webinar, we have discussed pending orders. Okay, so pending orders is a good example of a nice way to stick to a strategy, because on a pending order, or what is, if you didn't watch the previous webinar, I discussed a pending order is an order that will be triggered based on different market values. So if, for example, you're trading on gold, you can say, I want the position to be open when the price of gold hit this value. And then the position will be triggered automatically. You can also set yourself your risk exposure and your risk appetite in advance by setting a stop loss and take profit. And this is a tool that you can use to ease up your emotional trading. So you set things in advance, and then basically you don't touch it if you don't want to, because the trade is already set, the plan is already set in advance. So this is one tool, for example, that you can use in your trading, which is equivalent to a pending order. What other tools you can use? Obviously, risk calculator, a margin calculator, so you know how much money you have in the account and you know what kind of position size you can open and what will be your approximate profit and loss when the market hits a certain value. So all these things you add to the plan. Before you open the trade, you need to know what obviously is your plan, how much money you can potentially win or lose on a certain position. And it's going to make your life way, way easier because it's all written down. And then you know approximate profits, approximate losses, what kind of direction I think the value will go to. I think gold is going to break that resistance or support point, and I think it's going to happen on the 10 or the 12 or the 15. And then we can proceed. If you have more questions, feel free to ask. Working with the account manager, the client of AvaTrade, you can request a call from an account manager. Normally, we offer it to accounts above a certain threshold, above 1,000. You're eligible for a call with an account manager. You can request one-on-one session on the platform. That's just a tool that we offer to our clients. You can request that call from your account manager if you have one, or just from customer support. And as I mentioned, normally it's above a certain threshold. And basically, we finished our presentation regarding psychology of trading. In our next webinar, we will discuss more about the way that I will be presenting the webinar. So we are going to discuss something regarding the markets. Okay, for example, in our previous webinar, we discussed how to open trades, how to close trades, how to monitor your trading history, how to set stop loss, take profit, calculation of profits, calculation of margin, of losses. We discussed all these things. You can watch that previous webinar we had. In our next webinar, we will go through the MetaTrader. So I'm not sure if you have the MetaTrader set. I suggest that for the next session you set it up, set the MetaTrader 4 or 5 application on your mobile phone device, on the phone and on the computer. And if you're having issues to log in to that, so again, you can ask account manager to help you to log in. And in our next webinar, I will share with you how to log in to the MetaTrader and how to set your charts so you can see everything and you can place orders. The reason why we will be discussing MetaTrader because this is the main platform where you can execute trades from. Obviously, you can use our website, you can use our app, but it's very recommended to have that as well available for you. Additionally, to have the MetaTrader set. And you can feel free to ask me before we finish the webinar if you have any more questions. I hope you enjoyed this webinar. I know that many people always throughout the years really needing this subject. So that's why we started doing this specific webinar. I will be attending another webinar next year. I see we have another question. How can I start in this field without money because I don't have the funds? And how can I start in the field of digital marketing and on which platform? This question is not really related with our subject. We're really discussing trading. So if you do not have money, it's not really relevant because you need money to place orders. And that's all, everyone. Thank you very much for attending the webinar. You can watch the recording. Will be launched soon on our YouTube channel. And again, I hope you enjoyed the webinar. All the best, everyone. Take care. Bye.